In Nepal, the traditional financial mindset treats the fixed deposit as the standard for capital preservation. However, when we look closer at the mechanics of these accounts, a different reality emerges, one where this vehicle performs a systematic reduction of wealth. We call this the fixed deposit illusion. It is a discrepancy between the nominal payouts advertised by commercial banks and the actual purchasing power the depositor retains. For 2026, the advertised average for a nominal fixed deposit at a commercial bank sits at a seemingly stable 4.5% per annum. But after accounting for the fiscal and inflationary friction, that 4.5% nominal yield becomes a real return of negative 1.725%. That is a direct extraction of purchasing power. In Nepal's current financial ecosystem, the standard fixed deposit is no longer a risk-free choice. It is a mechanical process that applies a guarantee annual penalty to your capital. Welcome to the Himalayan Investor. Today, we are applying first principles mathematics to analyze the internal mechanics of the retail banking model. To see how this works, we will track a single localized unit of capital, a nominal principal of exactly 1 million rupees, or 10 lakhs. We will follow this 10 lakhs through the banking and taxation systems to identify exactly where wealth is lost. Once the underlying math is firmly established, we will look at how commercial banks leverage this capital pool for institutional arbitrage. Our goal is to move beyond the role of a passive liquidity provider and begin building an architecture for actual wealth. We begin with the starting block. An investor places a nominal principal of 1 million rupees into a 2026 commercial bank fixed deposit. At the advertised 4.5% interest rate, the account generates a gross annual interest yield of 45,000 rupees. Before this yield reaches the investor, it encounters the first layer of capital friction, the government fiscal multiplier. In Nepal, this multiplier takes the form of a 5% withholding tax applied directly to all interest income. This withholding tax removes exactly 2,250 rupees from your gross yield. This leaves you with a net post-tax cash yield of 42,750 rupees. In nominal terms, your effective payout is now 4.275. When we apply the net real return formula, pitting the 4.275% effective payout against that 6% core inflation baseline, the value drops. The final mathematical reality is a net negative result of negative 1.725%. This negative 1.725% represents a precise annual extraction of purchasing power from the retail saver. This raises a critical question. If the saver is losing wealth, where is the value of that locked 1 million rupees actually going? Commercial banks act as financial intermediaries, utilizing the retail sector's demand for safety to fuel their own operations. The bank secures its capital base from passive depositors at a very low cost of funds, that same 4.5% nominal rate you receive. They then package this capital and deploy it as leveraged debt to corporate consortiums. This capital flows into national energy infrastructure, including high-value hydro projects. It also funds large-scale mass transit and commercial real estate developments. Banks charge these corporate borrowers lending base rates that range from 10 to 12%. The difference between the 4.5% paid to the saver and the 12% charged to the corporation is the net interest margin. The bank captures this entire spread. In this system, the corporate borrower builds inflation-hedged assets, and the bank captures a high-yield spread. The retail saver provides the liquidity that funds both, while absorbing the resulting capital devaluation. To move forward, a premium investor must fundamentally reallocate their capital. The first step is to stop viewing the fixed deposit as an investment vehicle. Its only viable purpose is as an emergency reserve tool. This reserve should be capped at 3 to 6 months of absolute operational living expenses. The negative real yield on this specific portion is a calculated insurance premium paid for immediate liquid security. It is not meant for growth. By strictly limiting your exposure to fixed deposits, you stop the leak in your portfolio and prepare the rest of your capital for productive use. You must now transition your long-term capital into assets that are hedged against inflation. This means targeting high-yield dividend equities that can outpace the 6% inflation baseline. You should automate wealth building through systematic investment plans via mutual funds. For advanced portfolios, consider allocating a calculated percentage into emerging digital value assets. Building wealth requires moving past the perceived safety of retail banking and taking ownership of your capital allocation. Stop providing the cheap liquidity that funds institutional profits. Start architecting a portfolio for real-world yield. This is the Himalayan Investor.